Ever wondered why some investors seem to make money like they have a cheat code while others lose it all? What if there was a secret mathematical formula that told you exactly how much to invest to maximize your gains while protecting you from going broke? Well, there is. And it's called the Kelly Criterion. This formula has been used by professional gamblers, hedge fund legends, and even Warren Buffett. But be warned, misusing it can be worse than not knowing it at all. Today, we're breaking it down in a way that's easy, fun, and might just change how you invest forever. Most people make one of two mistakes when investing. Either they bet too little and leave money on the table, or they bet too much and wipe themselves out when luck turns against them. Let's say you found an investment that, on average, wins 60% of the time. You might think, great, I'll go all in. But what if a streak of bad luck hits? Boom, you're broke. Now, imagine a different scenario. You're overly cautious, only betting a tiny amount every time. You never lose much, but you also never really win. What if there was a way to size your bets just right? That's exactly what the Kelly Criterion does. The formula itself is deceptively simple. Where? F is the fraction of your bankroll to bet. P is the probability of winning. B is the net odds received on the bet. For example, how much you win per dollar wagered. Let's take an example. You flip a biased coin that lands on heads 60% of the time. Every time you bet $1 and win, you get $2 in total, meaning the net odds are 1-to-1. Plugging in the numbers. Meaning, you should bet 20% of your money each time. Betting more or less than this optimal amount leads to suboptimal long-term growth. Too much, and you risk ruin. Too little, and you fail to maximize your edge. The Kelly Criterion isn't just for gambling. In investing, the same principle applies. Imagine you have two investment opportunities. 1. A high-risk biotech stock that has a 70% chance of doubling, but a 30% chance of crashing to zero. 2. An S&P 500 ETF, which grows steadily at 8% per year but never crashes. Kelly tells you not just which to pick, but how much to allocate to each. But there's a twist. Markets don't work exactly like a coin flip. Risks change, correlations between assets exist, and leverage plays a role. That's why even hedge funds using Kelly usually scale down their bets to half Kelly or even quarter Kelly to stay on the safer side. Leverage can be a double-edged sword. Kelly suggests betting aggressively when you have an edge. But in markets, black swan events, rare, unpredictable crashes, can wipe out even the smartest traders. Remember long-term capital management? They thought they had cracked investing, using mathematical models to make risk-free bets. Until they weren't. Their highly leveraged portfolio was obliterated in 1998. Now, it's time for you to test your intuition. Question: if a game has a 70% chance of doubling your money and a 30% chance of losing it all, what percentage of your portfolio should you bet, according to the Kelly Criterion? A. 50%, B. 40%, C. 20%, D. 70%. Answer: B. 40%. Why? Plugging the numbers into Kelly's formula. But since real-world investors reduce risk, most professionals apply half Kelly, leading to around 20% as the ideal bet. What was today's key takeaways? 1. The Kelly Criterion is a powerful tool for maximizing long-term wealth, but only if used correctly. 2. Overbetting leads to financial ruin, even in a positive expected value game. 3. Real investors scale down Kelly's recommendation to account for unpredictable risks. 4. Leverage is tempting, but must be used cautiously. 5. Even legends like Warren Buffett understand the importance of position sizing and risk management. So, what do you think? Do you agree that Kelly is the best way to size your bets? Or do you prefer other risk management strategies? Comment below. And if you enjoyed this breakdown, hit that like button, subscribe for more deep dives into investing wisdom, and check out our previous video where we explored how Warren Buffett secretly uses Kelly's principles. See you next time. Stay smart, stay strategic, and never bet it all on a single flip of the coin.